The top 5 CDs with rates of up to 4.5%, even after the latest Fed rate cut. Hello, Diamond NestEgg members, Super Savers, and course fans. I hope you're healthy and well. As requested by quite a few of you in our community who hold CDs in your portfolio, today's video will cover the best CD rates for December 2025 that we've come across. And somewhat to my surprise, we still found a CD offering a 4.5% rate at the time of this taping, and more financial institutions with 4.1% and higher CD rates, which isn't too bad given that the Fed just lowered rates by 25 basis points to between 3.5% and 3.75% this past Wednesday. Of course, most of the CDs with such attractive rates are generally shorter term. So for those of you who want to lock in some of the more attractive current rates for longer, we'll also take our usual weekly look at what medium and longer term treasuries, agencies, and annuities are paying. Here are the 3 topics that we'll be covering today. 1. What are the best CD rates that we found for you this month? 2. How do current rates compare for treasuries, agencies, and annuities? And 3. What are the predicted yields for the upcoming week's Treasury auctions? Let's dive in now, folks. What are the best CD rates that we found for you this month? We have 5 different options for you today, so hopefully one of them will fit your individual circumstances, goals, and expectations. All of the CDs that we'll be sharing with you in this video are FDIC or NCUA insured to the best of our knowledge. The FDIC insures individual accounts at banks, and the NCUA does the same for credit unions, but both offer the maximum protection of up to $250,000 and have more or less the same terms and conditions. For those of you who want a deeper dive into how FDIC and NCUA protection work, I've linked these 2 videos in the first pinned comment below for you. There are restrictions for some of the higher CD rate promotions, but that's to be expected given the above market rates. And we will walk you through what these conditions are and whether you may be able to meet them, which may be of particular interest to those of you who are considering opening a CD with a credit union. Some of the top offers on our list today are from credit unions, meaning you will need to become a member. Let's start with the CDs that have the lowest APY and end with those that have the highest APY. We have 2 names on our list today that offer 4.1% for more than 12 months. And you may be able to find more CDs with a 4.1% rate, especially for shorter maturities, if you look around a bit. Beginning alphabetically, we have Marcus by Goldman Sachs, a name that has appeared in our best rates videos before, and is probably familiar to many in our community. There has been a bit of noise in the market about Goldman's commitment to Marcus and online retail banking more generally after it ended the credit card partnership with Apple and sold its robo-advisory to Betterment last year. Now, we can't comment about their strategy, but we are inclined to see this special 14-month high-yield CD as a sign that they're not about to exit the savings and deposit space. This 4.1% 14-month CD is available nationwide online. The 14-month term length is a limited time offer available until December 17, 2025. But please note that even if you make the deadline, your rate might still be different as Marcus reserves the right to change the rate going forward. So from how we read the fine print, Marcus recommends the following approach. If you open a CD today and deposit at least $500 within 10 days, you will lock in the rate shown here. Marcus's approach to CD rates has a positive side as well, though, in case rates go up, just for future reference. As they state on their website, deposit at least $500 within the first 10 days of opening. If the rate we offer changes during this time, you'll get the higher rate automatically. Marcus is a maximum deposit of $1 million per CD, and if you need to access your money before the CD matures, the early withdrawal penalty will be 180 days interest, as appears to be the standard for CDs that are 12 months or longer. The second name on our list to offer 4.1%, if we go alphabetically, is Sallie Mae Bank, the online banking arm of Sallie Mae. Sallie Mae is relatively well known for the private student loans it provides. It used to be a government-sponsored entity until 1996. However, it is now 100% private with no government ownership, guarantee, or special privileges, which means that your deposits with Sallie Mae Bank will be insured by the FDIC up to the usual limit of $250,000. But there are no special guarantees on top if you're considering a higher amount. Speaking of amounts, the minimum deposit to open a CD is $2,500, and individuals can open personal or joint accounts nationwide online or over the phone. We could not find a limit for a maximum amount at Sallie Mae Bank, but as always, we recommend staying within the FDIC limit. The 4.1% is available on this 15-month CD here, but 4% for the 12-month CD is a decent rate as well. And you can even lock in the same 4% for 60 months with this CD here, if you want, which is rare these days. The other terms and conditions are quite standard from what we could see, including a 180 days interest penalty for early withdrawals. The next name is U.S. Alliance Financial, which offers a 4.18% special rate on the 12-month certificate and a 4.15% special rate on an 18-month certificate. Special rate here means that at maturity, these certificates will automatically roll over to a regular, non-promotional, non-special certificate of the same term at the then current regular fixed rate. You can change this selection anytime before maturity, and you even have a 7-day grace period after maturity for members to alter their rollover choice. This is market standard for special rates, so please keep in mind that whenever you buy a special rate CD, you should make a note of the maturity date. Otherwise, you may automatically be locked into the next CD with a rate that you may not love with the same maturity if you miss a deadline at maturity, which means that you may be subject to early withdrawal penalties if you need access to your money. The early withdrawal penalty for both these CDs with a maturity of 12 and 18 months is 180 days interest, again, which may produce a noticeable dent in your returns if you do not hold to maturity. If you are interested in these competitive special terms, you will need to become a member of U.S. Alliance Financial to buy their certificates. What is now U.S. Alliance Financial was initially started as a full-service, not-for-profit in 1966 to serve IBM employees in the New York tri-state area, and they are still a federal credit union and a member of NCUA today. They've grown far beyond their initial base to over 150,000 members and are essentially accessible nationwide. For those of you who don't meet any of the narrower community-based criteria that still reflect their roots in the Northeast, a popular option is to become a member of the American Consumer Council, ACC, online, which may even be free and will qualify you as a member. The minimum to open a CD with U.S. Alliance is $500, and we could not find any maximum. That said, we always recommend you stay within the standard $250,000 limit. Next on our list, and already pretty close to our winner today, is the 11-month bonus rate certificate from Municipal Credit Union with 4.4%. A minimum balance of $5,000 of new money is required to open an 11-month share certificate. And while we could not find any maximum limit on the amount that you can invest, you can only add any funds for up to 7 days from the date the account is opened. All additional funds must be new money as well, meaning they cannot be on deposit with MCUA currently. As I said before, we recommend you stay within deposit insurance limits, which is the usual $250,000 for the NCUA, like for the FDIC. After the initial 11 months are over, the account will automatically renew into the promotional 9-month certificate at the then current rates. As I said before, don't miss any deadlines here, or you may be automatically locked into the next CD at the then prevailing rates and at a different term of 9 months rather than the original 11 months. Municipal Credit Union, or MCU for short, was founded in 1916 for municipal workers in New York City. From these beginnings, it has expanded to 15 branches and more than 600,000 members today. But you still need to meet one of the 3 membership conditions: live, work, worship, or attend school in New York City. work for New York State or federal employer, or be an immediate family member of an existing member. If you have such a bond to New York, though, membership is free. And as a personal comment, this seems to be one of the rare instances where living in New York City actually brings a tangible fringe benefit, and not just the higher cost, extra city income tax, and other negatives that everyone living in the city has to deal with. And finally, our winner today is New Vision Credit Union. New Vision was founded in 1935 as the credit union for employees of Douglas Aircraft Company and is headquartered in Huntington Beach, California. Now, the Douglas Aircraft Company has long ago merged into Boeing, and maybe that's one of the reasons why New Vision has outgrown its West Coast aircraft manufacturing background and has become active nationwide via its digital offerings. And in keeping with this wider reach, New Vision's online application process includes the possibility to sign up via the American Consumer Council, which is pretty much open to any consumer, and we've seen the same path to credit union membership before. New Vision offers 4.5% on a 4-month CD with a special and time-limited offer that comes with a few restrictions. It is only available until December 31st, 2025. There's a minimum balance of $1,000, but also, and maybe more important to many of our super savers, a maximum amount of $5,000. Every member can open only one of these special certificates. The special 4-month CD will roll over at maturity into another 4-month CD at the then prevailing standard rates, and there is a penalty on early withdrawals, and most other usual provisions apply as well. So, that was our top 5 CDs that still pay up to 4.5% at the time of this taping. Please keep 3 points in mind, though, before you send in your money to one of these providers. First, if you live in a high income tax state, it may make sense to compare the CD rates you're considering with Treasury rates, because interest earned on CDs is fully taxable, whereas interest earned on Treasuries is only taxable at the federal level, but exempt from taxes at state and local levels. As a point of reference, here's where Treasuries stand at the current time. More on these Treasury yields shortly. Second, all rates we've talked about in this video are as of the time of this taping and subject to change. So if you do decide to move ahead with any of the financial institutions that we've discussed today, please do refer to the links in the first pinned comment below for the most current details on rates, minimum balances, fees, and so on. And third, we don't have any affiliation with any of the financial institutions we talked about today. If you do have an account or other relationship with one of them, drop a comment below and let us know what your experience has been like, both good and not so good, so that our Diamond NestEgg regulars know what to look out for. Now, let's move on to the next section of today's discussion. For those of you who may be interested in locking in the current attractive rates for a longer time period than what the CDs that we've shared with you today can offer. How do current rates compare for Treasuries, agencies, and annuities? As we normally do at the end of the week, let's compare the annuity, agency, and Treasury rates at the time of this taping, going from the highest rates, annuities, to the lowest rates, which is usually Treasuries. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes on the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to Treasuries and non-callable agencies in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that they don't pay interest regularly, but accumulate it in the account and pay out everything together at maturity. So let's begin with some sample rates for MYGAs. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.3%. A $50,000 7-year MYGA might earn you 4.4%. A $100,000 7-year MYGA might earn you 4.55%, and a $1 million MYGA might earn you even 4.6% for 7 years. And if you have more than the amounts shown here, say north of $10 million, your rate might go as high as 4.7% with this AA+ insurance carrier this coming week. So basically unchanged from last week across the entire maturity spectrum shown on this table. As our Diamond NestEgg regulars already know, because annuity rates track interest rates, they continue to be at above average levels when you compare them over the most recent 20-year period. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on a number of factors, including how strongly or not so strongly the insurance company you're buying your annuity from is rated. Meaning how risky or not risky your insurance company is, as I've already mentioned. It will also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's move on to non-callable agencies and treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty, for example, 10%. So, as this table shows, the rates on non-callable agency bonds range from as low as 3.55% for a 2-year term up to 4% for a 7-year term. This is the first time in months that we found a 7-year non-callable agency at 4%, by the way. And the rates on treasuries range from as low as 3.52% for a 2-year term up to 3.95% for a 7-year term. So a bit lower on the short end and a bit higher on the long end, which is in line with the continuing steepening of the yield curve. But more on this shortly when we talk about treasury yields. And what we continue to see here is that for a 2-year term and for amounts under $100,000, the rates for MYGAs, non-callable agencies, and treasuries are all pretty similar, between 3.5% and 3.6%. So as I've said before, if it were me, I would probably go with the 2-year T-note if this was my time horizon, given the small difference in yield and the generally higher liquidity of treasuries. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over non-callable agencies and treasuries, and more substantially so the further out you go and the more you invest. So, if you are comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends, or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Annuities come in many different flavors. MYGAs are more like CDs, whereas FIAs, fixed index annuities, allow for potentially higher market-based returns tied to the S&P 500, for example. FIAs come with full principal protection, but also with an upside cap, and might be something to consider if you want to stay in the stock market for the higher returns, but are concerned that we're headed towards a market correction, as we discussed in these 2 recent videos on how to protect your money against a bubble. Link below in the first pinned comment for your convenience. The first-year cap on a 7-year FIA for amounts $100,000 plus still stands at an attractive 9.25% at the time of this taping. For a 7-year cap that stays the same for the life of the FIA, that number also continues to be worth a look at 7.25%. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments, and QLACs, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. You can check out these annuity videos here, all linked below this video, if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. or shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists to see what your options may be, because there is no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations and fit properly in your overall portfolio, regardless of size. Moving on now to our usual table with Treasury yields from this past Friday versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black and decreases in rates are shown in red. The Treasury yield curve continued to steepen this week, which is market speak for saying that shorter maturities are paying less and less, while longer maturities are paying more and more. You can see it at a glance on the table. All maturities 3 years and below are red, meaning they have lower yields than a week ago, while all maturities 5 years and longer are green, meaning they're paying more than a week ago. Now, a steepening yield curve is generally seen as a positive sign by the markets. You should get a higher yield if you lock up your money for longer. And of course, the opposite. A negative yield curve, where longer maturities pay lower rates than shorter maturities, is generally seen as a sign of pending economic trouble and potentially even a recession, as many of us still remember from the times not too long ago when we actually had a negative yield curve. That said, the markets are still playing a bit of a guessing game on why exactly the yield curve is currently steepening. Is it really a positive outlook on the economy? Or could it actually be a fear of higher inflation or general risk premium for the overall uncertainties around our economic outlook and whether the Fed will continue to cut rates next year or pause for a while, or perhaps all of the above? Basically, a risk premium for the fact that nobody has a strong conviction for what 2026 may hold. Drop a comment below and let me and the community know. Why do you think the yield curve is steepening? Curious minds want to know what the mood amongst our Diamond NestEgg regulars is. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, this last row here shows the increase or decrease in rates since the beginning of this year. And again, increases in rates are shown in black and decreases in rates are shown in red. For the first time in quite a while, we see green on this table. The 30-year is yielding 6 basis points more than at the beginning of the year, and the 20-year is not that far away from it. Overall, this comparison confirms that the yield curve is steepening again, as we just discussed, and this holds true for the two most often looked at comparisons, the 2-year versus the 10-year, and the 1 month versus the 30-year. The real upside here is that the steeper yield curve opens up new investment opportunities for retail investors. First of all, you get more interest if you invest in longer-term treasuries or comparable products like annuities. Now, no one has a crystal ball and can predict how rates will develop going forward. But if you can live with the uncertainty and think that long-term yields may be coming down again, then now might be a good time to buy some longer maturities to lock the rates in, or to simply add some longer maturity treasuries, agencies, annuities, or other bonds to your portfolio as you continue to dollar cost average. It really all depends on your personal outlook, but our current rates are still quite attractive if we compare them to the average yields over the past 20 years. And if you're willing to be more active, you could potentially make an extra profit from trading your bonds when an opportunity arises. If that's something that interests you, I'd like to invite you to have a peek into our soon-to-be updated member zone. In the replay of our latest member live, linked in the first pinned comment below, you can hear us discuss what retail investors like some of us in this community can do to make the most out of a steepening yield curve. In this context, we touched upon profit-taking on bond positions that show a paper gain, and also discussed more advanced strategies like carry and roll, and when they might make sense for a more ambitious retail investor. Our members drive the agenda, and if there is interest, I'm pretty sure we'll talk more about that, as well as about what potential Fed rate cuts might mean for your personal portfolio, and how you can still generate a stable income flow for your retirement in times of lower yields. At least that seems to be the direction we're headed towards at the moment. So you can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where Treasury, agency, and annuity rates ended the past week, let's move on to the next section of today's discussion. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bill auctions are happening as usual. And if we scroll down, we can see that the 20-year T-bond and the 5-year TIPS are also on the auction schedule. Both of these are reopening auctions, so we already know what the coupon will be on them. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.646, the 13-week at 3.596, and the 26-week at 3.569. For the 20-year T-bond auction, the coupon is 4.625, and the expected yield is 4.808, which means that buyers in this reopening auction will likely pay below par given that rates have moved up since this coupon of 4.625 was set at the original 20-year T-bond auction a few weeks back. For the 5-year TIPS auction, the coupon is 1.125, and the expected yield is 1.4, which is a bit lower than the average real yield of 1.53% over the past 12 months, but substantially higher than the current I-bond fixed rate of 0.9%. So, if you're comfortable with TIPS, this may be something to take a closer look at. Remember, though, that whereas I-bonds are pretty much straightforward, TIPS like annuities can get complex and fast, especially if you need or have to sell those TIPS before maturity. That said, for the right investor who's willing to invest a bit of time to understand them, they may be worth the effort, as both TIPS and I-bonds offer something that's not easily available from other investments. Bond beginners, folks, please refer back to these two modules here on TIPS and I-bonds for a refresher. Also, the break-even inflation rate on the 5-year TIPS was 2.32% at the close of market last Friday. As a reminder, the latest inflation report from the BLS, the U.S. Bureau of Labor Statistics, showed both annual inflation and core inflation coming in at 3% at the end of September, and inflation seems to generally have been more or less stuck around this level. So, if the 5-year TIPS fits your timeline, goals, and expectations, you want to add some inflation protection because you believe that inflation over the next 5 years will average more than 2.32% annually, and you're comfortable with the complexity, overall lower liquidity, and tax nuances of TIPS, then this may be an auction to consider dollar cost averaging into. Please also keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. And if the annuity rates in this table have piqued your interest, do check out these annuity videos here or drop us a note at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialists, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your individual circumstances, goals, and expectations and fit properly in your overall portfolio, regardless of size. All right, Diamond NestEgg members, super savers, and bond courts fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.